Hi, Barbara Freeberg here. Today I'm going to be talking to you about the recent stock market volatility, or should I say, basically, stock market declines since the beginning of 2022, and how to cope with cyclical investment markets. It's the beginning of March now, and to look at a quick chart of the Standard & Poor's 500 SPY ETF, which is the dark blue line here, you'll notice that since January 1st, the SPY or S&P 500 index fund has declined 7.8%. Now, that can be a little scary for those of us that haven't been investing for a long time, and that can cause you to worry. Should I get out of the stock market? Should I sell now? What should I do? How should I cope? And I entitled this, How to Cope with Cyclical Investment Markets, because if you're investing in the stock and less so in the bond markets, you have to understand that the price you're paying for those returns above and beyond the returns that you would get from a bank account, the price you're paying is there's some volatility. That means your stocks, your bonds, their prices are going to go up and down. Now, if you can't handle that at all, or you're shocked by that, well, now's a good time to learn how to cope and make the decision whether investing is right for you. And so let's get started. We're going to go over this chart because, okay, I love charts. They show information in a way that talking just can't do. I've got the price chart here from January 1st, 2022 of the S&P 500 ETF, which is this dark blue line. Then I have the VNQ, which is a real estate index fund, and that's the light blue line. Then the VEU is an international stock fund, global, without U.S. holdings. And the VEA is a similar international fund, but it has it's just focused on the developed markets. So what can we learn today from just looking at since the beginning of the year? Okay, first of all, as it's clear, all of these funds, all of these different sectors of investments, stock market investments, have declined. The S&P 500 has declined, or the real estate VNQ has declined over 10% this year. Whereas S&P 500, and this isn't taking into account any dividends. So understand, if you receive dividends on these funds, and they all do pay dividends, your returns will be a little bit different. But the S&P 500 fund has declined nearly 8%. The pink VEA, which is the developed markets ETF, has declined 7.1%, while the all world VEU, which includes some of the emerging markets funds, emerging market companies, which are less developed than the bigger companies that you would find in the more developed, like European markets, that's only dropped 6.3%. So you could say, wow, that's actually done a lot better than the S&P 500 and the REIT, or real estate index fund. Any way you slice it, though, if you were invested in the stock market this year and you noticed your returns, they're all negative. Now, there may be a few sectors that have gone up. Probably commodities have gone up as well. That's in contrast with last year, the S&P 500. Let's look at a 2-year chart now. It's not a year to date, but it's 2 years. And you'll notice a completely different picture. Over the last 2 years, even including 2022, your S&P 500 has increased nearly 48%, while the other 3 index funds have increased 17%, which is not too shabby. So stock markets go up and down. Now, if we look at the 5-year, you're going to see even better returns because the stock markets up until 2022 were going gangbusters. So what do we do now? Should we just sell and run for the hills? Well, I'm going to pull up this really cute chart from US Bank, which shows kind of what we go through when the stock markets are going up and when they're going down. Here we are. And as I said, stock markets are cyclical. They go up, prices go up, and prices go down. So you need to learn how to cope with the emotions that you're going to have, both when stock markets are going up and when they're going down. As the prices go up, you feel awesome. Oh, I'm thrilled. I'm euphoric. My return at the end of 2021 was 28% for the S&P 500. Okay, beginning 2022, things are not looking good. Prices are going down, temporary setback. I'm a long-term investor. I can hang on. Continuing to go down. I'm getting a little desperate. I'm panicking. And then at some point you might be feeling, and it may be now, may not be till later. If we see a greater drop, you may go, maybe the markets just aren't for me. But then at the very decline, when people are the most scared and most despondent and most depressed, that is where you have the greatest financial opportunities. So if you sell here because you think stock markets aren't for me, I can't handle this, what happens? You miss the rebound when stocks go back up. So I encourage you, how do you handle that? Well, first of all, you educate yourself. And that's what you're doing today by listening to this video and looking at these charts and these graphics. I've written about this topic because so many studies have taken place where you'll find that although maybe over the long term, 10, 20, 30, 50 years, overall the stock market has received an average of maybe 8-10% a year, annualized. That hides the fact that some years the stock market has had losses. It also hides the fact that many investors haven't profited from those annual gains because they get scared and they sell here, 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 and here. And I encourage you, please don't do this. Look, I cannot guarantee the future. Who can? And anyone who says they can, well, probably is lying. Actually, they're definitely lying. So let's take this chart even further out. And this is going to 1994. And you'll see the SPY is the only ETF in our group that's been around since 1994. But you get the idea. Look, there was a huge market run-up from 1994 till 2000. Well, you've heard of irrational exuberance and the busting of the dot-com bubble. That happened at the beginning of 2020. And stock prices fell pretty drastically till 2003. But if you held on at that time, you didn't sell, and you continued reinvesting your dividends, you ended up owning more shares. And from 2002 on up to 2008, you had a really nice run. Okay, there was a little drop here in 2009, 2008. But then since then, up to 2021, you're looking at what return since 1995? In the S&P 500, you're looking at a 347% total return. That's amazing. And you may think, well, why do I need to do that? Why don't I just sell here? I'll buy back here. Then I'll sell here, buy back here. The problem is picking the top and bottom of investment cycles is super easy. In hindsight, in advance, it's not so easy. And if you miss the best up days over long periods of time, your returns will not match the averages. They will be much lower. So let's figure out some practical steps about what we should do during these times when many of us are feeling panicked and we're worried that the stock market is going to keep going down. Before we go any further, I want to say any money that you need this year, next year, and for the next 5 years, be it for a home down payment, be it to pay off debt, or to meet your loan payments, your college tuition payments, to put down on a house, that money should not be in the stock market. Simple reason, we just saw the charts. You can't predict the future. So if you've held out the cash that you're going to need for the next 3 to 5 years, let's talk about what you can do next. So what causes these drops? Well, currently, right now, the drop was set off by fears that interest rates are going to be rising. Jerome Powell, the head of the Federal Reserve, has as much as told us so. Inflation is very high now. Your dollar is buying less. And that is a scare to the investment markets too, although some stocks will improve because they'll be able to increase the prices of their goods. Other causes of stock market crashes between 2000 and 2009, we had the mortgage meltdown, subprime lending crisis, debt European crisis, 9/11 terrorist attack, wars in the Middle East, growth of China as a world competitor. So there are any number of reasons that the stock market has fallen in the past, is currently declining, and will do so in the future. So let's get to something a little happier. How do we benefit? How do we profit? We've already looked at the long term. Here's a picture of the stock market from January 1, 2020 to 2022. It looks pretty nice. And then we've seen, of course, the declines. We've seen long term, and there's no guarantee the past is going to keep up with the future is going to replicate the past. But if you believe in the US and global economies long term, you can expect that buying mutual funds, exchange traded funds, individual stocks that represent ownership in these companies is going to prosper over time. And if you think that won't happen, well, we've got bigger problems if you think that won't happen. Growth typically goes in cycles, kind of like this cute little graph here. These are the cycles, they call it investor motion. It's also a cycle of asset prices, economic growth. There are times when the economy is growing, and then there are times when it is not growing and slowing down. So if you understand that, you're not going to be freaked out when the economy, when the stock market tends to take a pause or even a reversal. We know what is causing the declining stock prices now. I've mentioned them. Here are a few others. We've got supply chain constraints. Stock prices are pretty rich now, and we typically measure stock prices by their price earnings ratio. And that is simply the current price divided by some measure of earnings, either last year or the past 10 years average. And higher values mean the stock, you're paying a greater amount of dollars for $1 of earnings. And today, you're paying a lot more for stocks, even after the correction, than we have paid in the past. So that's another factor to think about. Stocks can be overvalued actually for quite a long time, and it doesn't mean they will immediately go back to fair value, but at some point, they typically do return. So when stocks are highly valued, the markets are more susceptible to corrections that might occur from global factors or from national factors like rises in interest rates, inflation. Okay, so investors, what are we going to do today? How can we profit? Don't get out of the stock market at the bottom. I implore you, if you're in it, don't panic, because more likely than not, there is going to be a reversal. And if you get out now, you have to be right twice. You have to be right about when you get out, and you have to be right about when you invest back in. And you have the risk of missing a lot of the upturn if you sell now and expect that you are going to hit the bottom and buy back in at that point. It's very, very unlikely. So here's what we do. Choose an asset allocation you can live with. That's your mix of stocks versus bonds versus cash, real estate funds, that sort of thing. If you're older, if you're in retirement, if you don't have a lot of time to make up for losses, you'll own greater percentages of more conservative assets like stocks and fixed income. If you're younger and you have time to weather economic stock market declines, you might have a more riskier portfolio. But age isn't the only determinant. So there's some really cool quizzes you can take to help you figure out what the best asset allocation is for you. I'll put those in the show notes below. Then, unless you're a stock picker, you love this stuff, or you just want to really delve in, your best bet for investing is just choosing low fee exchange traded funds, kind of like some of the funds I used, for example, in our chart at the beginning of the video. Choose them in a mix of bond funds, US stock funds, international stock funds, and I'll direct you to some sample portfolios as well. Then be patient. Despite the promises of fast profits when markets are speeding up, in the long run, the patient investor typically wins. I'm also going to include a free giveaway for you, which shows how one of our retirement portfolios increased 900%. Now, clearly that wasn't within 1 year, but it'll help you understand how long-term investing can, over time, create surprising amounts of wealth if you are patient, if you continue investing through thick and thin. Regular investing matters. We sometimes call that dollar cost averaging. And here's a little example. If you invest $4,000 per year from the time you are from 25 to 65 in a diversified investment portfolio like we have been discussing, assume that that diversified mix of assets earns you about 7.6% on average. And again, average means some years you'll get great returns, other years not so much. But over those 40 years, that's going to be your average return. You will retire with $1 million. That's not a bad chunk of change for $4,000 a year investment. Most of us who are working can swing that amount. Finally, keep the money that you need for short-term expenses in a conservative cash or very short-term bond investment. Accept the ups and downs of cyclical investment markets. Realize they are the price you pay for being an investor in financial markets. And if you are lured by speculative investments, quick profits, cryptocurrency, individual stocks, options, a lot of more aggressive strategies, then by all means, give them a try, but not with 100% of your investment dollars. Allocate a small percentage, say 5% of the amount that you invest, to try out other strategies. If you lose it all, it won't catapult your financial future. If you win, great, you've made some profits. So I am Barbara Friedberg. Please, if you like this video, give me a thumbs up, subscribe, ask your questions below, and I will see you next time. Bye.